It's easy to look at people's lifestyles online and feel like we are completely off track with our money. But what if I told you that you might be actually closer than you think? In this video, I'll break down 5 of the core financial ratios that I use with my clients that might help you understand where you are with your finances and where you can improve. But first, what is a ratio? A financial ratio provides a way to be able to measure different aspects of our finances and compare them to standardized benchmarks. Since everyone's financial situation is completely different, then it gives us a way to be able to kind of gauge where someone is in their finances and be able to compare it against other people without the numbers being exactly the same. So to illustrate, we'll dive into the first one, which is the savings rate. So the savings rate is the percentage of our income that we save or invest. So let's say that someone makes $50,000 a year. And let's say that every year they save $1,000. Then their savings rate would be 1,000 divided by 50,000, which equals 0.02 or 2%. So their savings rate would be 2%. Now let's say that the same person, instead of saving $1,000, they save, let's call it $5,000. Then the ratio would be 5,000 over 50,000, which is their income, which is 0.1 or 10%. So the industry standard here kind of varies based on age, income, and the goals of each person. A 20-year-old who is starting to invest for retirement typically needs a lower savings rate than someone who is 50 and they're just now starting to save for retirement. Because the 20-year-old has much more time to be able to invest and to be able to contribute into the market, then they can tend to save a lower percentage of their income in order to be able to still reach that goal. But if you only have a few years to be able to reach a goal, then you need to be much more aggressive in your savings rate. A good range, just to put this into perspective, is around 10 to 15% of your income should be saved and invested. Now you can do these calculations for yourself and determine how much you've saved or invested over the last year, and then simply just divide it by your income, and that will give you your savings rate. So if you find that it's below the 0.1 or 10%, then you might consider increasing. But again, all of this varies based on your goals, your age, and what you're trying to accomplish. So this next ratio is one of the most important ones, and I heavily stress it with my clients, but it's often overlooked, and that is the emergency fund ratio. The emergency fund ratio shows how long you can sustain yourself in an emergency situation, such as job loss or medical issues. So the way to calculate this is to take your monthly non-discretionary expenses and divide it by the amount of money that you have in your savings account. And by non-discretionary expenses, I mean, what do you need to keep the lights on? You've got to pay your rent, you have to buy groceries, you have to put gas in your car. Those things that are non-negotiable, you need them in order to live. Now, things like concert tickets and dining out at restaurants, that would be discretionary. And that makes sense, right? If there's loss of income, then it makes sense for us to restrict our lifestyle to only paying for the things that are most important. So buying new shoes or going out to eat, all of those things can be restricted in an emergency situation until the income level is back. And so let's run through that here. So let's say that someone has $1,000 in rent, and let's say that their grocery bill is $600 a month, maybe $650 now since eggs are so expensive. Let's say they spend $100 a month on fuel. You've got $120 in utilities. These are all just made up numbers. You've got $100 for a phone bill, which my phone bill was $100. You've got $80 for internet. And so you would just go throughout this list and figure out what it is that you cannot live without, essentially. And then we'll add these together. So what is that? 1,000, 16, 17, 18, 19, $2,000. In non-discretionary expenses. And so let's say that this person has $5,000 in savings. So then we would take the $2,000 a month and divide it by the $5,000 that they have in savings. And what is that? 0.4. So this right here would be the emergency fund ratio. To simplify this in my own mind, I think of this as number of months. And so this person could sustain the $2,000 a month payments for 2.5 months before they run out of cash. Now, a good benchmark for this is 3 to 6 months. But given the fact that more people are doing gig work and there's more volatility within the market, if you're a business owner or a single income household, the benchmark should be 3 to 12 months. And the way that we think about how much you need in your emergency fund, if you have two incomes, if one person were to lose their job, then it's not like you're having to withdraw the entire amounts from savings to be able to pay your bills. Let's say if only one person has an income, then it would make sense to increase that amount either to 6 or upwards of 12 months. I think 12 months makes a lot of sense if you're in a job that is difficult to obtain, if there are very few of them, if it's highly technical, where those jobs don't really come up onto the market all that frequently. I would highly recommend increasing the emergency fund to closer to that 12-month period. And that feels bad. Like it's a lot of money just sitting in cash, sitting idle. But the times that you need it, you really appreciate having it. All right, for number 3, we're going to talk about ROI, which stands for return on investments. I think the easiest way to give an example of this is to take a yearly amount. Let's say that somebody has $50,000 in their investment account. Now, let's say that they contributed in January. Let's say they added $5,000 to it. So at the end of January or whenever they inputted that cash, then they now have $55,000 in that investment account. Now, let's say over the course of the year, this $55,000 appreciates to $60,000. So after 12 months, that $55,000 grew to $60,000. So the way that we would calculate this is we would take the ending amounts, which is the $60,000, minus the original amounts, plus the additional contributed, divided by the original amount. And it really is that simple. So in this example, 60,000 minus 55,000 divided by 50,000 is 0.1 or 10%. And this is really important. So whenever you're investing, it's important to understand what kind of return that you are receiving on your investments. Now, if you're investing in things like stocks and equities, whatever app that you're using will typically show you what your percentage is over given periods of time. But I think it's important to understand what those percentages represent and how to calculate them for yourself. That way, if you are investing in things like collectibles or cryptocurrencies or other assets that aren't easily tracked, then you know how to make this calculation for yourself. And you can look at your the other aspects of your portfolio to know where certain investments line up and whether they're meeting your expectations. Okay, next we're going to talk about the housing ratio. Now, the housing ratio measures what percentage of your income that your housing expenses take up. This ratio is typically looked at by mortgage lenders when you are looking to purchase a home, but I think it's very valuable to look at even if you're renting, because you don't want your housing costs to be too much of your income. If your housing costs are too high the percentage of your income, then it might make it difficult to actually pay your housing costs. And so keeping this at a very reasonable level is important, regardless of whether you are renting or purchasing a home. Now, if you are purchasing a home, this can be calculated through a simple acronym, and that is PITI. Now, it stands for principal, interest, taxes, and insurance. So let's say that someone's principal is $600. Let's say they're paying $400 in interest. Let's say their property taxes are $100 a month, and their insurance is $200. So the entire package would be $1,300 a month. And let's say that this individual brings home $6,000 a month. So easiest way to do this calculation is just divide it. So $1,300 over $6,000 a month. And this comes out to 0.216. Multiply that times 100. That's how you get percentages. Be 21.6%. Good rule of thumb is under 28% for these costs. You can do this with renting as well. Even if you don't have interest or taxes, you can simply take your rent and insurance, which if you don't have renter's insurance, I highly recommend getting it. Let's say that rent is $1,000 a month and your renter's insurance is like $20 a month. So renter's insurance is very inexpensive. So $1,020 a month. In the same scenario, divided by $6,000 a month income, that comes out to 0.17 or 17%. So even lower here. But it's important to note, like, even though this is lower on a monthly basis, when someone owns a home, they're still contributing to the principal. So their equity value of their home goes up over time. That's beyond the scope of this video, but just wanted to point that out as well. All right, next up is the non-housing debt ratio. Now, this is not like a standard financial ratio that you typically see in textbooks. However, it is one that I look at for my clients because it shows a different aspect of debt levels. And that is the non-housing debt ratio. And basically, this just shows how much debt do you have that's not related to your home against your income. So just like we did this calculation for the housing ratio, we're gonna do that for all non-housing debt. So let's say that someone has a couple of credit cards, credit card 1, credit card 2, student loans, and let's say they have a auto loan as well. Let's say that their monthly payment on the first credit card is $145 a month. Say credit card number 2's got a lower balance, so let's say $80 a month. Student loan at $300 and auto loan at $400. So add up all of these together and we have $925 per month. Divided by the same $6,000 income gives us 0.154, which is 15.4%. So with this ratio, we want this as close to zero as possible, because typically things like credit cards, student loans have higher interest rates, auto loans have higher interest rates. Basically, all of these don't really have any assets to back them up, right? At least with the house, we have a piece of real property that traditionally goes up in value over time. At least historically it has. I'm not saying that that will occur in the future. It just has in the past. And so for non-housing debt, all of these things are considered unsecured, except for the auto loan. Now, at least with the auto loan, there's a car to back it up. However, the car will depreciate over time. It doesn't appreciate over time. So it will go down in value while your note is also going down as you pay it off. Whereas the credit cards and the student loans, there's nothing really to show for it other than learning and whatever you purchased on the credit card. And so good rule of thumb is for this to be as close to 0% as possible. Pay off this debt. Like, this stuff kills so many people's financial futures, it's not even funny. The amount of interest that you pay on credit card loans is absolutely ridiculous. Same with student loans and auto loans. And so if you have these right now, you need to be figuring out a strategy to, one, figure out your emergency fund, get that at least to 1 month's level. That way, if something were to happen, you have a little bit of cushion. And then number 2 is get rid of this non-housing debt. Bring this ratio down. That will increase your income because you're not having to spend it here. And then from there, you'll be able to either increase your emergency fund ratio to a higher amount because you can take that $925 a month that you were spending on debt and you can now save it. So you see how all of this kind of connects. By improving one section, we improve the ratios of the others. And that's kind of the point. If you do this on your own and you realize that your ratios are out of whack, it's okay. We just need to identify what is the starting point and what is it that we need to do in order to get you back on track. For most people, it's getting that little cushion of emergency fund. So get that started. You don't have to reach the full 3 to 12 months immediately. Just get 1 month in the bank, and that will free you up to be less stressed about your finances and then really hit this non-housing debt, bring that as close to zero as possible, and then we can address other aspects of your finances. So I hope this video was helpful and insightful to you. If you have any other questions or other ratios that you would like for me to cover, I'd be more than happy to do so in a future video. Otherwise, hope you all have a wonderful week ahead. Take care.